conference has been muted.
Alrighty. Good afternoon, everybody, and welcome to our webinar, 2016 Developments in Health and Welfare Plans. My name is Amanda, and Larry Grugine will be your presenter today. We have a lot of information to go through, so we may run about 5 to 10 minutes over today, but don't worry if you don't catch everything. We're recording this webinar, and we'll email you the video and the slides after the webinar ends. Our next webinar is on July 12th at 1 p.m. Central Time, and we'll be covering changes in overtime regulations, which I know has been a big concern for a lot of our clients. We have a lot of participants today, so I'll be keeping the conference on mute. Larry will pause for questions periodically, and I'll unmute you so that you can ask them, or if you'd prefer, you can type them in the question box below, and I'll ask them out loud for you. Other than that, please enjoy.
Thank you, Amanda. I appreciate it. If you look at the slides, I have, I think, 78 slides. I'm not going to cover all of them in detail. Some I'll just refer to because what I want to concentrate is on those changes that I think are extremely important. And you can go back and read the rest of the slides at your leisure. Now, what's interesting about this is I'm just including changes from December 2015, and that's the last time we had this seminar. So I'm going to be reviewing final regulations in EEOC, IRS, DOL, a new law that was passed in December of 2015. So all that's occurred since December of 2015, and we had a seminar then. The first thing I want to talk about is Notice 2015-87. They came out in December of 2015, and there's a few items I want to point out. First of all, in 2015, they addressed a number of issues, and this was ACA related in regard to employer-sponsored coverage, focusing on account-based plans, reporting and defining hour of service, and providing guidance. And this was important on COBRA coverage and health FSA carryovers. All right. Now, in regard to HRAs, what they indicated, and it was kind of fuzzy. Under ACA health reimbursement arrangements, in order to be compliant with ACA, has to be integrated, which means it has to be offered with a group health plan. And what this ruling indicates, what this notice indicates, that starting in 2017, in order to meet the requirements of ACA, everybody that's eligible under the HRA also has to be covered under the group health plan. So if somebody has single coverage, all right, only that individual can participate under the HRA, not their entire family. So if somebody chose to have single coverage, the only expense that the HRA can reimburse is that individual. If you want to cover the family members, they also have to be participating in the group health plan, either of the employer or another employer. Also talk about flex contributions. In regard to employer contributions to flex plans, so these are many times an employer said, well, here's $200–300 a month. What you can do is spend it on medical coverage, dental coverage, and what Notice 2015-87 said is that employer flex contributions will be treated as being used for health spending if the employer may not opt out to receive the amount as taxable. The employer may use the amount to pay for minimal essential coverage, and the employer may use the amount exclusively to pay medical coverage. So in determining whether that's an employer contribution, it's going to reduce the amount of the affordability. Those are the conditions, as you see in that slide, for flex contributions. So flex contributions can be used to pay for dental or vision or be reimbursed in cash. They will not be considered under healthcare reform for affordability. And then and this goes on the detail in regard to that. Now, Now, another important issue is next slide is opt-out contributions. Many employers have them, and this notice 2015-87 said, okay, if you're going to give an employee a payment for not receiving coverage, and there's no conditions on it, that's going to up the amount that the employer will pay for coverage. And this indicates the conditions for it. Well, they indicate they're going to, and so this ruling is not going to be effective until 2017. And if you give employees cash, and what the IRS said, and this is explained on this slide, if you condition the opt-out payment on having other coverage, then that opt-out payment won't reduce the employee contributions for the coverage, and therefore you're not going to be in trouble. So again, this is a new ruling, how to categorize opt-out payments. And if the opt-out payments have a condition that you have to be covered by another plan, then they will not be considered an increased employee contribution. Also, too, in regard to payments under Davis-Bacon and other rules, federal contractors are required to either pay for additional amounts for salary or fringe benefits, and as it indicates, until the IRS issues guidance how to treat these cash payments for any plan year ending, for end of the plan year beginning before January 17th, cash payments as increasing affordability. So if you're subject to any of those contracts, that's extremely important. So, and again, this is in Notice 2015-87, in determining affordability. In the past, we've always used 9.5%, but now what they're indicating, there's going to be adjustments. It's going to be 9.56 in 2015, 9.66 in 2016. So that number for affordability will be adjusted on a year-by-year basis. Also, the amount of the penalty involved will increase. The $2,000 penalty will increase to $2,080 in 2016 and $2,160 for 2016. And then the $3,000 penalty will increase, and I can't read that because, let me just, oops, sorry. It's over $3,000, and it's $3,240 for 2016. So again, just know that the penalty amounts would be increasing every year. Also, the hour of service, the Notice 2015-87 clarified what is deemed to be an hour of service, what will be considered. In regard to counting someone's hours, it's all hours that they get paid for. Any amounts due for vacation, holiday, illness. It doesn't include any amounts paid after that person terminates employment, which means any severance payment paid after someone leaves will not be considered. And also it does include any amounts paid when someone is not providing services, which includes short-term and long-term disability. Also, special rules apply for employees of educational institutions with breaks in service. Remember, for educational, instead of being a 13-week break in service, is a 26-week, and that's important to determine whether someone's full-time or not. If someone comes back within 26 weeks, then that person is not considered to be a new employee. In regard to this, some avoiding the rule by claiming employees are actually employed by staffing agencies. This is an important factor for educational institutions. In that situation, you have to consider whether that individual, how much control the educational institution has over those employees, and the IRS is considering a rule that would provide that educational institution exception would apply to employees who are providing primary to the educational institutions, and they would be considered to be educational employees. Also, in doing filing, a separate employer ID number would be required for each governmental entity that is subject to the reporting requirement, and separate Form 1094Cs must be filed. Now, what's also very important, previously there was no guidance in regard to COBRA coverage in regard to health FSA carryovers. This has been allowed for a couple of years. There's been no guidance, and employees are allowed to carry over up to $500 each year, and so we had no idea how those carryovers are going to be considered for COBRA purposes. Now, what the IRS said in 2015-87, the maximum amount that the FSA is permitted to require in COBRA coverage, and again, because these amounts are already paid by the employee, what they're indicating here, there won't be a COBRA premium in regard to health FSAs. So there's no COBRA premium for those carryover amounts if you've changed your health FSA to be to include a carryover. There's no COBRA premium. Qualified beneficiaries must be allowed to carry over as non-COBRA participants, so such an employee will be not allowed. And what you can say in this is the fact that you can only be allowed to, will not be allowed to any additional salary reduction. And carryover period is going to be 18, 29 to 36 months. So, and again, a qualified beneficiary must be allowed to carry over, the same as any non-COBRA beneficiary. Such individual will not be allowed to any additional salary reduction contributions. And an individual may condition the ability to carry over unused amounts in regard, you have to participate in the health FSA in order to do so. The employer can say, in order to use the carryover, you have to participate. Now, are there any questions in regard to that? Why don't we open up for questions? Anybody have any questions?
Just a second.
The conference has been unmuted.
Does anybody have any questions?
This is going too fast for me. It's all sorts of nitty-gritty FSA.
So anybody have any questions? All right, why don't you mute everyone?
Alrighty.
The conference has been muted.
Consolidated Appropriations Act of 2016. And this was signed by President Obama on December 18th, 2015. It included a few benefit provisions, as this indicates. Now, the most important change is the Cadillac tax was delayed until 2020. This is a major concern of everyone, and it was originally going to be in place in 2018. It has been delayed for 2 years. So, and also they've changed it so the Cadillac tax will be deductible before it was not deductible. Another change is, as this slide indicates, the extension of parity of exclusion from income of employer-provided transit and parking benefits. This parity is an exclusion for combined employer transit. This was effective in 2015. So for 2015, the monthly limit on exclusion for combined transit and van pooling is $250, the same for parking. And for 2016 and later years, the same monthly limit will apply for the combined transit pool and van pool benefits. Now, the question is, and later guidance has indicated this, how can the employer go back to 2015 when this was passed at the end of 2015? That would be covered in a few minutes. Also, what's very important, and the final throngs of this, is the IRS extends the due date for Forms 1094 and 1095. And this was in Notice 2016-4. So on December 28th, the IRS announced that they were going to grant an automatic extension for providing the forms to employees and also to filing with the Internal Revenue Service. Now, what's important, and the reason why I'm bringing this up right now, is the very common question I've been getting is that because they've granted an automatic extension, will there be any other extensions past this? And the answer is no. Since everybody got an automatic extension, the drop dead date will be in a few days. So furnishing statements to individuals, that was extended from February 1st to March 31st of 2016. Filing paper returns were extended from February 29th to May 31st. And filing electronic returns were extended from March 31st to June 30th. So this has to be happening over the next couple of days. So again, as I just want to stress, and the reason why I'm bringing this up, because everyone was granted an automatic extension, they will not grant any other extension. So the drop dead date, as you see in this slide, is June 30th of 2016. Now, what the IRS has announced is the fact that we're going to be operating this year in good faith compliance. So if you make mistakes or don't file it on time, the IRS may not impose any penalties on you if you made a good faith effort to file it. What I'm telling my clients in this situation is if you can't meet the June 30th date, I don't think there's going to be, because this is the first year and there's all kinds of issues and problems with electronic filing, I think if you make a good faith effort to file it over the next 2 weeks, I don't think there would be penalties. But again, that's just me, because there's been all kinds of issues and problems with electronic filing. So please understand that, and many people still haven't filed the paper returns because these forms are extremely complicated. But just understand the fact that we're operating under good faith compliance, and the IRS has not defined yet what they're going to consider to be good faith compliance. So again, these are automatic. The new deadlines are more generous than otherwise available. And again, they obeyed any penalties for any good cause someone can demonstrate. So please be careful, and what I'm advising people is the fact that try to get them right when you file them. The biggest concern I have, because these forms are extremely complicated, make sure that between the 1094s and the 1095s, the information on them is consistent. Make sure the EINs match. Make sure the codes match. Because if they're inconsistent, they may throw out. Now, what we've been experiencing over the last several weeks, and the IRS has been throwing out forms, is because of mismatches in Social Security numbers. What's happening is the AIR system that's been using this to file this is a more sophisticated system than the system used for W-2s. So for some employees, for example, the old system, the W-2 system, would accept the Social Security number of an individual. But the AIR system is more sophisticated, and if they're inconsistent and used by someone else, they will note that and throw those returns back to you. So the mismatch is real. Many of my clients have been getting those messages. So please understand that what that means is that the Social Security number is incorrect. And that means that employee may have given you a wrong Social Security number, an incorrect Social Security number, or a fraudulent Social Security number. You have to go back to them and get the correct number. All right, as I indicated before, there's the ability, and this was released in Notice 2016-6, explaining how employers can correct FICA tax overpayments resulting from higher 2015 limit and reporting proper amounts and income on Form 941 W-2. Now, this is the ability, for example, if you as an employer were withholding higher amounts for parking and transit, but you were collecting tax on that, you have the ability of rebating tax back to your employees if you were doing this. So employers may reduce 2015 taxable wages on the Form 941 by the amount of the transit exceeding $130. Employers cannot retroactively increase the 2015, so this only applies to those employers who were withholding the higher amounts, taxing it now. Then what they're doing is then rebating back to the employees any increased taxes, the difference between 130 and 250. You can't go back and increase that amount on the employee. So for employers that treat transit benefits in excess of the limit, you can do that. If they haven't filed the fourth quarter 941, they have the ability of giving a rebate to the employees, and this is what this slide indicates. So this procedure allows employers to forgo filing 941s and correct the error, and again, rebate the amount of taxes to the employees. So for employers who have already filed their fourth quarter, they may not use this special procedure, so this was very limiting. So if a W-2 has not been furnished to employees, it may be adjusted. So again, this is a very limited procedure that allowed employers to rebate taxes on the increased amount, because when they increased the parking from 130 to 250, it was retroactive back to 2015. Amanda, do we have any questions? Do you have any questions?
I don't have any in the question box, but let me unmute and see if anybody has some.
Does
The
anybody
conference
have
has
any
been
questions?
unmuted.
Does anybody have any questions? Anyone?
In obtaining the Social Security numbers from the employees, if the IRS is coming back and stating that it's something...
Could you speak up a little bit? I have a hard time hearing you. I'm sorry.
With the corrections from the IRS that state the Social Security number is incorrect due to the ERS system being more sophisticated than the W-2, we are suggesting a copy of the Social Security card from the employee. We don't know if it's the employee or if it was the dependents that are wrong. Is that a correct way to proceed?
And now the next question is, suppose you go back to the employee and said either your Social Security number or the Social Security of your dependents are incorrect, and they say they have no explanation why it's incorrect. They can't come up with another number. And the next question is, what you as an employer can do. So they have no explanation of why that Social Security number is incorrect. So what can you do? Well, in that situation, I think if the employee cannot give you another number that works, basically what they've done is committed fraud, and I think they can be subject to termination.
Thank you.
So again, you want to give the employees a chance to give you another number, because they may have inputted it wrong, they may have transposed numbers, whatever. That's an innocent mistake. But if the number they gave you is fraudulent, that could be grounds for termination.
Okay.
We're experiencing that as well at our company, and we're not able yet to find any employees who have given incorrect socials. So I would tread carefully in terms of termination or any action.
Well, you have to be careful in that, and give employees the benefit of the doubt, and give them time to give you a new number. But again, I mean, and what I've been discovering in talking to my clients is the fact it's probably more prevalent among dependents than it is among employees. So you could have problems because especially if you're self-funded, you have to list all the dependents on the 1095-C, and they were supposed to give you a Social Security number. If not, then they were supposed to give the date of birth. And some people may made up numbers, so I mean that could be a big problem.
Okay.
Any other issues or questions?
I have a question on the transmittal control code number.
And he showed me once before, but it'd be good if...
Could you speak up? I'm having a hard time hearing you.
Yes, I have a question on the transmittal control code number. I had a client that was ready to file today electronically, and then they realized they had not applied for that number. And the IRS is telling them it would be anywhere from 15 to 30 days before they get that number.
Yes.
So again, I'm just telling them if they're applying the good faith effort, they should be okay. I understand there's a limit of 250. Is that employees or the number of, what is that 250 number?
It's the number of 1095-Cs that you're filing.
Okay.
Not the number of employees. It's and again, it applies separately to each member of the control group.
Okay.
So if you have, for example, if you have a company with 3 different divisions, and each division is filing 100 forms, and the total is 300, that 250 limit applies separately to each member of the control group.
All right. Thank you.
Now remember, and this is a very common problem, when you're filing your 1094s and 1095s, and we've discussed this earlier, but I just want to go through again, which is extremely important, the proper way of doing it. If you're a company with 3 different divisions, and each division has their own EIN, each separate division has to file their own 1095s and 1094s. And the information on the 1094s has to be particular for that separate member of the control group. Their numbers, and it has to be an authoritative transmittal. So they have to complete all of the 1094-C, including questions 21, 22, and also into parts 3 and 4. In part 4 of the 1094-C, you have to list the other members of the control group. Now the reason why they did this, because the employer mandate applies separately to each member of the control group. That's why they're doing it this way. So again, depending on how many divisions you have, you may have multiple 1094-C filings. So please understand that. All right? Are there any other questions or issues? All right, let's continue. Why don't you mute people?
Yep.
The conference has been muted.
All right, CMS announced another extension to the transitional rule. It basically allows insurers in the individual small plan market to continue to offer policies that are not in compliance with certain insurance market reforms. This has been going on probably since 2014, and now what this notice is indicating from CMS, we're permitted, and again it varies from state to state. Insurers can renew it for policy years beginning on or after October 1st, 2017, so they extended it another year. But again, any policy renewed under this transition will not be considered out of compliance. They must be extended through December 31st, 2017. And it just explains the list of reforms that are covered in this transition relief. And this only applies to those reforms after 2013. If any reform, for example, were effective before 2015, it wasn't covered under this particular transitional relief. So please understand that. So this applies both to individual and the small plan markets, and those coverages, even though they don't comply, so these are changes in 2014, they can continue to be offered even into 2017. Now, this next is extremely important. The Office of Civil Rights, part of CMS, or HHS, excuse me, is now launched a second phase of review under HIPAA privacy rules. So they're going to start auditing employers on compliance with HIPAA privacy. And as this indicates, the Office of Civil Rights will send pre-audit questionnaires to help identify pools of covered employee business associates representing a broad spectrum of audit candidates. And selection criteria of audits will include size and type of entity. Now, in the past, they've only audited basically providers and hospitals. Now they're extending it. They're doing more types of employers. So they will only audit those entities that would have not under an open complaint investigation. And on-site audits will examine a broader scope of HIPAA requirements. Entities selected for a desk audit will be sent email notifications, and that means people will not visit you. They will do it through their office. They will send you a list of requests. Now, one thing I'm concerned about here is that this may be just the first step. If they see concerns in this, they may, again, do an on-site audit if they find issues and problems. What I'm concerned about in my travels is that most employers have not complied with HIPAA privacy. When I talk to most employers, they say, well, I don't have access to PHI, protected health information, so therefore I don't have to do anything. 9 times out of 10, the employers are incorrect. They do have access to PHI, either through enrollment or through claims information, so please be very careful in this and review what you're doing in regard to HIPAA privacy, because I'm just bringing this up because they're doing a new phase 2 audit. And so there's a number of procedures involved, and there's one slide I just want to mention here. HHS, the Office of Civil Rights, has released an audit protocol, and in future seminars I'm going to go through this, and this will basically tell you what they're looking for. So they published, if you Google Office of Civil Rights HIPAA Privacy Audit Protocol, it will pop up and will tell you exactly what they're looking for. And this protocol identifies sections of the applicable rules, established performance criteria under each rule, and inquiries auditors will make to evaluate compliance. I would recommend getting those protocols to look and see exactly what HHS is looking for and what they're doing. So again, auditors refer on documents and other items furnished by the employer and business associates. And in some areas, prior versions may be requested. And protocol includes numerous references to information systems as defined as hardware, software, so they're looking at both procedures and your IT department. Are there any questions in regard to that? Amanda, why don't you open it up?
The conference has been unmuted.
Anybody have any questions? Well, I don't think there's any issues or questions, so.
Some lovely music.
So why don't you mute everybody?
The conference has been muted.
Oh, the DOL releases final regulations on fiduciary definition. Now, this generally applies to 401ks and 403bs and IRAs. But what's interesting in regard to this, basically, this generally applies to investment advisors. The only reason why I'm bringing it up here is because it also applies to health savings accounts. So there's new rules in investment advisors. So an investment advisor is one who, investment fiduciary is one who renders investment advice. And the final rule provides that individuals render investment advice. They provide other compensation, direct or indirect. And these are all the different recommendations that an individual, if they do work with a health savings account, they can become a investment fiduciary. Now, the reason why I'm bringing this up is the question comes in, could, in this situation, any employee of yours, could they become an investment fiduciary and subject to the rules under ERISA? And the DOL has indicated that, see now where it is, right here. I want to go to this slide. Plan sponsors will be relieved to know that their employee job duties include management, administrative, retirement, and other accounts usually will not be considered an investment fiduciaries. So we're not talking about anyone who works for you or those investment advisors that work for you as an independent contractor may be considered to be a investment fiduciary, which means there are special rules for them. So that's the reason why I brought this up. Next, just know that, remember, you have to provide SBCs to your employees. Agencies released final revised templates, and these versions will replace materials. Now, what they've indicated, and the reason why I'm bringing this up, there's new templates, and whatever template your either TPA or your insurance company, they have to be updated. So again, the new templates are substantially similar to the most recent proposals. There are a few changes, so you have to make sure and talk to your insurance company or TPA to make sure, because they apply for 2017. There are just a few changes. I include services covered before deductibles met, embedded deductibles. For the coverage examples, instructions explains generic cost notifications. And overall, the instructions provide more details than currently applicable. So there are a few small changes. They include new updated coverage examples. And use of this new template is for any plan years beginning on or after April 1st, 2017. So again, and in this situation, for calendar year plans, it's not to 2018. So new glossary definitions. So again, there's a few changes, and you just have to make sure the new ones are going to be used starting in 2017 plan year, starting after April. A few months ago, there are new amounts for HSAs, and this kind of indicates what the new amounts are. There's not been that many changes. This highlights exactly what the changes are for 2017. Now, one thing I want to discuss, I think is extremely important, is the new HHS Final Regulations extend broad non-discrimination for some health plans and TPAs outside the exchanges. There's a lot of confusion about these rules. And there is a broad non-discrimination requirement. And basically, health plans cannot discriminate on basis of national origin, sex, age, and disability. Now, there is a lot of confusion about these rules for 3 points. One, these are not the non-discrimination rules that we've been waiting for since 2010. That would be under the tax rules. These are HHS rules. What we've been finding out is the fact that the administration has been broadly interpreting discrimination for sex, and they're applying it for transgender services. Now, at this point, it only applies to those plans offered on the exchanges. So, federal and state exchanges have to comply with this. But the final regulations confirm the rules generally apply to exchange insurers, and because of that, insurers don't want to, again, offer different products, and they will probably extend it to other products. The rules also apply to employee health plans of certain employers who receive financial assistance and are particularly engaged in healthcare, hospitals, and nursing homes. At this point, we don't know how they apply to self-funded plans, whether it applies to TPAs or administering plans. So be very careful in that regard. If someone wants transgender services, there's an issue here whether these new rules apply in this situation to private self-funded plans. So please be very careful, because many insurance companies are applying these rules across the board. And as this slide indicates, the rules explain that sex discrimination includes discrimination based on gender identity. So again, this is an extremely hot topic, and generally applies to those coverages on the exchanges, hospitals, and providers. And there's a question on whether it applies to, again, private self-funded plans. And this explains the final rules make clear that the employer does not become by these rules just because they're self-funded. However, recognizing that TPAs generally do not control the design of the plan, HHS explains that it will process the complaint against the TPA. So again, talk to your TPA about see how they're going to administer this. There's a lot of misconceptions here. Next, the area of wellness programs. In April of 2015, the EEOC published proposed regs on wellness programs. In May 16th, the EEOC released final regulations, and basically in regard to compliance with wellness programs with Americans with Disabilities Act and GINA. And so there are guidance in regard to wellness programs, and these are extremely important. And GINA and ADA prohibit employers from obtaining information about employees' own health conditions in regard to family members and including spouses. But both laws, however, allow employees to ask health-related questions, conduct medical exams such as biometric screenings to detect risk factors. So again, the EEOC proposed final regulations last year, proposed regulations. Now, the final regulations, really what they concentrate on is defining and when wellness programs are voluntary. And in defining what is voluntary, they indicated the employer cannot require employees to participate, deny coverage under any of its health plans, or limit the extent of coverage, or take any adverse employment action against an employer who does not participate. What some employers were doing under wellness program, if you didn't participate, they did one of two things. The most egregious situation was denying any health coverage to anyone who didn't participate on the wellness program. The less egregious, but still in violation, was a situation where someone said, okay, we're going to offer you 3 plans as an employee, but if you don't participate under the wellness program, we're going to only offer you 1. You're still going to be offered health coverage, but 2 of the plans are going to be off limits to you. Under the final regulations, the IRS was very clear that an employer cannot do that because it would be deemed not to be voluntary. Also, what's very important is the fact that how much the the wellness either credit or penalty could be. And what this slide tries to explain is the fact that now, for all types of wellness programs, from participatory through outcomes-based wellness programs, the most that any incentives can be is 30% of individual or self-coverage. So even if a individual has their family participating, basically what this is saying is no, we don't care how many individuals are participating, the maximum wellness benefit is only 30% of individual coverage. So please understand that. This is a major development and a major limitation. And the HHS regulations didn't put that limitation on, and they didn't apply that 30% limit to participatory wellness programs. Very important. So participating in an employer's group health plan cannot exceed 30% of the total cost of individual coverage, the total cost of the lowest cost self-only coverage, the cost of self-coverage available to a 40-year-old under the second. So these are various limits that you can participate under. Now, you may ask yourself in this situation, well, I thought there was a 50% limitation for smoking programs. And basically, yes, that's true. So under the regulations, provide a wellness program can have an incentive up to 50% on individual coverage, but what they've indicated here, in order to get that 50% limit, the employer cannot do any screenings for tobacco. So if tobacco-related incentives are tied to the results of any bio-screening or other medical examination, the 30% limit applies, and some employers were doing that. We're testing individuals for tobacco. If you do that, you don't take the employee's word for it, then you're limited to 30% of the individual limits. So these are extremely important developments. They're applicable for plan years beginning on or after January 1st, 2017. So again, at your next open enrollment, you have to, again, if you have a wellness program, you have to comply with this EEOC Final Regulations. Let's stop for a second and see if anybody has any questions.
Sure thing.
The conference has been unmuted.
Does anybody have any questions? Anyone?
I have a question. Can you hear me?
Yes.
So we offer health coverage for no cost to employees at 2 of our locations. And I was wondering if that means we can't provide a wellness incentive for biometric screening to employees that work at those locations.
Well, it's 30% of the single coverage, so, I mean, what you can do, you can give them a reduction. Oh, that's right, because you pay for it.
Yeah, so they don't pay anything in premiums.
Well, I mean, what you can do is give them a cash payment of so much. Now, that cash payment would be taxable. So if you want to say to individuals, I'm going to give you $100 to complete to participate, you can do that. But if you give them a cash payment, and the IRS just indicated that if you give them a cash payment, that cash payment would be taxable.
To send this message, press pound or hang up. To play it, 3. To re-record it, 4. To add to it,
Could you put it on mute?
That's what I was doing. Do we have any other questions?
Does everybody have any other questions?
All right.
So again, please make sure you comply with these final regulations because, again, they're applicable for plan years beginning in 2017. Now, we're going to have a seminar July 12th on this topic. But I just want to introduce to you the new overtime rules.
All right, just 1 second, Larry. I didn't get a chance to remute everybody.
Okay.
The conference has been muted.
These are probably the most important impact on your company, depending on your employee base. They are effective as of December 1st, 2016. And what the final regulations do, and this is for the white-collar employee exempted benefit, accepted employee limits. So it sets the standard salary level at the 40th percentile earnings of full-time employees in the lowest wage census region, currently in the South, $913 for a full year worker. This is increased from $455 and $23,000. That's the total annual compensation requirement for highly compensated from literally $100,000 up to $134,004. So basically what this is saying is that when you have an exempt employee, and there's a white-collar exception, and also in considering wages, in considering bonuses can only be considered if the bonus makes up to 10% of the standard salary, and it has to be paid quarterly. Bear with me a second. Now, there's no change to the duty test under the exempt rules. The effective date is December 1st, 2016. And this slide tells you the limits on the amount of the compensation. And so that the $913 comes to approximately $47,000 a year. And for the highly compensated, it's risen from $100,000 to $134,004. There's going to be future updates beginning as of January 2020. So again, the issue and problem is going to be is that no matter if you call someone salary, if their wages are below $47,000, that white-collar exemption doesn't apply to them. And as a result, you'll need to count hours and pay overtime for hours in excess of 40 hours per week. So despite the fact that they are a manager, if they make less than $47,000 a year approximately, you have to pay them overtime. So employers have a full range of options in responding to this. You can either raise salary and keep the employee exempt. So even if you call them salaried employees as opposed to hourly, it doesn't matter. For this purpose, they would be considered to be non-exempt. Pay overtime in addition to the employee's current salary when necessary. Evaluate and realign hours and staff workload. Determine how the reclassification of some employees as non-exempt employees, does that affect their eligibility for employee benefits? Because now, basically, they are now hourly employees. And some employers have different benefits between hourly and salaried employees. So this could be a whole realignment of how you pay your employees. So again, what's important, you have to keep records. You have to start counting hours. And it's up to the employer to choose the method that works for them and needs of their workforce. There's no requirement that the employees punch in and punch out, but you have to justify the hours. In case of an audit, you have to justify how many hours those employees are working. So employers will have flexibility in designing systems to make the appropriate records are kept for the number of hours worked. You have to justify why that person wasn't being paid overtime. Are there any questions? And again, we'll go into avid detail. I think I have 45 or 50 slides on this. I'll go into avid detail on this, but this is going to be very devastating to some employers. Does anybody have any questions?
Oops, sorry about that.
Why don't
The
you open it
conference
up?
has been unmuted.
Okay. Does anybody have any issues or questions? Anyone? No questions, really?
All right.
Yeah, but it'd have to be a little bit later. As a matter of fact,
Oh, that's not a question.
webinar.
Okay.
Anybody have any questions?
The conference has been muted.
Very much, and I finished on time.
Alrighty. Like I said, we'll be emailing you the slides and the recording shortly. And our next webinar is on July 12th, which will be covering overtime regulations, which I know a lot of people have had some concerns about.
And we'll go into avid detail. I didn't cover that in depth today because I knew I was going to do it in 2 weeks. So take care, everyone.
Alrighty, have a great day, and thank you again for
Bye-bye.
joining us. Bye.